Good morning. Welcome to 3 Minutes on Markets and Money. Let's talk about yield spikes. That's what's going on right now, of course. The 10-year yield has been spiking up here the last day or so, getting bond traders worried and also impacting the equity market a bit here as tech shares tend to not perform as well underneath a rising rate environment. Now, again, as is always the case, we tend to extrapolate these little pops in interest rates as, oh my gosh, the bond bull market is over. We're now back to the bond bear, and this is going to be terrible. Interest rates are going to go to the moon. Look, it's always possible, but probably not. A lot of this yield spike here over the last 3 days is really over concern of what's going on in government right now relative to the debt ceiling debate, as well as the government shutdown, which comes at the end of the month, so at the end of this week. Yesterday, the GOP shot down a bill that would have lifted the debt ceiling and provided funding for the government through the end of this year. But the Democrats have the ability to pass this bill entirely on their own. They just don't want to. They want bipartisan support on lifting the debt ceiling because the midterm elections are coming up and they don't want to own the entirety of lifting the debt ceiling all on their own and spending this $3.5 trillion that they want to push through under Biden's Build Back a Better America plan. This is leading to some consternation. The bond market's not sure about what's going on here, so we're seeing yields spike here. This is not really that big of a concern. The debt ceiling will pass. There will be an increase in funding. And if the Democrats want to pass their $3.5 trillion spending bill, they can certainly do that. They're now talking about splitting that bill up into different parts to try to get this through with more moderate Democrats as well. So all of this will eventually ease off pressure on bond yields in the short term. And historically, when we've seen these types of spikes in yields, they've tended to be good buying opportunities to add fixed income to your portfolio at lower prices. Another couple of reasons you may want to think about that, as we discussed before, is also just the risk in equity markets. Equity markets are very extended here. We've had a very large run this year, still very deviated from long-term means. And the Fed is talking about taper. Now, the Fed tapering, that doesn't really work that well for equities eventually because you're removing liquidity from the markets. And during that period of time when the Fed is tapering, that tends to lead to a change in risk preference by investors. In other words, investors opt for risk off rather than risk on. And during Fed tapers, historically, we see interest rates fall, not rise, as that risk preference changes to more of a safety mode rather than a risk on mode. So again, keep a watch here on yields. They are getting very extended here. They are overbought short term. Probably going to wind up being a good buying opportunity. Maybe not just yet, but let's get through this debt ceiling through the end of this week. Democrats likely to pass the bill before the week is out. We'll see what happens then, and we'll report back to you tomorrow right here on 3 Minutes on Markets and Money.